Hello and welcome to the latest instalment of the Market Financial Solutions Let's Talk Property podcast. Before we dive into today's episode, I want to take a moment to share a quick disclaimer. Market Financial Solutions are a bridging loan and buy-to-let mortgage provider and are not legal, financial, investment or tax advisors. This content is for informational purposes only and does not and should not be considered to constitute legal, financial, investment or tax advice, or be relied upon by any person to make legal, financial, investment or tax decisions. Therefore, investors are encouraged to seek appropriate professional advice. The opinions and views expressed in this episode are personal to the host and guests and may not reflect the views of Market Financial Solutions. Now, let's get started.
Welcome to the next episode of Let's Talk Property podcast. And today I am joined by the lovely John McCaffery. So John is a tax guru, if you will. But officially tax partner and head of tax at Alexander & Co.
That's all correct.
So fabulous. Thank you. So do you want to do a bit of an intro?
Certainly. So yes, we are an independent firm in Manchester. And we deal exclusively in advising entrepreneurs and family-owned businesses. Been around for 50 years next year. And we got into property on the back of a vast amount of our entrepreneurial clients having issues with commercial and residential properties. And also the fact that once they've made some money, it was an area they wanted to invest in. The advice they were being given wasn't spectacular. So we started putting the work in and became a little bit of expert in that field.
More than a little, but yes. And our paths have crossed many times over the years. So I'm delighted that you're joining us today. Thank you ever so much. So let's dive in because I have got a boatload of questions to ask you and pick your brains on. So let's start with, so we're just going to go with just initially some tax sort of fundamentals.
Sure.
Some of the questions that we get asked by our brokers and in turn they get asked by their buy-to-let landlords. So why is it important that customers seek independent tax advice?
Am I allowed to say Angela Rayner? Can I say Angela Rayner? And it's nothing to do with political jab there at all. It is the fact that the UK, not just property, the UK has the world's biggest tax code. It's 40,000 pages long. It has grown up over years and years and years and years. It is messy, it is complex, and it turns on details. There are a large number of very good accountants out there, but unless you are specialising in tax, you are likely to miss something. Tax is one of your biggest costs as a business owner, a property owner. And if you miss something, when you add in the interests of missing it and the potential penalties of missing it, it can get very expensive. So getting upfront tax advice could save you a whole heap of money and pain later in the future. Yeah,
absolutely. And we've seen a number of landlords that maybe haven't taken that advice that are obviously now maybe not quite in the right tax structure that they should be, and obviously feeling that pinch as a result of it. So how much tax will a landlord pay on their rental income? Now, obviously, I appreciate that it depends on how much they're actually earning, but if they've got an employed job, they've also got a property as well. Yep. Typically, what sort of tax are they going to be expecting?
So it very much depends on what they're earning. So property income is added to your total income in the year.
Right.
Okay. So if you've got a job, if you've got any savings, interest and that kind of thing, property is added to all of that. And then the tax calculation is applied. Okay. Now, if your total income is above roughly 52,700, somebody will correct me, you fall into the higher rate tax bracket.
Right.
Right. That puts you at a 40% bracket. Okay. Once you're in that bracket, and no doubt we'll come onto it later, the amount of interest relief you can claim is restricted. Comes off the tax you pay rather than your taxable profits, which you'll no doubt come on to later. And as a result, you're paying an additional amount of tax on your rental income because of the restriction on your interest. Once you breach 100,000, you're in a very funky tax bracket because between 100 and 125,000, you lose your tax-free amount at the beginning. So you're in an effective 60% tax rate. And then above the 125, you drop back down to the, much more affordable 45% tax rate.
Fabulous. Yes, I often hear my other half moaning about
Yes.
that side of things, so I'm fairly familiar with it myself. But so how is the rental income actually calculated then? Is it based on the gross or the net income after you, for instance, with like letting fees and things like that, when they're calculating it?
Hybrid, and it comes back to that interest point I was telling you before, right? So you are taxed on your rental profits, okay? So you get your rental income in, you can deduct things like relevant repairs, your management fees, the costs you've incurred in running the property, and that will give you a rental income profit, hopefully, if you're doing it right. What you can't deduct is your interest, okay? Doesn't mean you don't get any relief for your interest, but you can't deduct your interest, right? So let's say you were in that scenario and you had, 10 grand of rental income and 4 grand of management fees, right? Your taxable profit is 6,000. Okay. You work out your tax on that. Let's say I picked a worst figure I could have in the world then. 6,000. You pay 40% tax on that.
Yeah.
Right? So you pay your 40% tax on that. Then you take your interest. Now, let's say you've got a 5 grand interest cost.
Yep.
Okay. So previously, if you'd had 6 grand of income you'd have taken your 5 grand off and left with 1 grand of taxable income, right? Now, what you do is you take 20% of your interest cost and deduct that off your tax payable, leaving you with a much higher tax bill.
And if you do have a landlord, for instance, that has losses, for instance,
Yes.
for whatever reason, maybe they've done works to the property, etc., are those sorts of things that they can carry forward to offset some of that tax bill and liability?
They can offset against future property income, right? So other losses have a bit more flexibility in them. So if you've got trading income losses or that kind of thing, there is a option to offset against other streams of income. Well, property is streamed against property. So if you make a property loss, you can only offset it against property income.
Right, okay. Not just your general wider tax bill. And I think that's a common misconception as well.
It is.
So,
I see a lot of errors in that kind of thing.
Yes, you do. So let's look a little bit more closely with regards to ownership structures, because we've touched on the personal ownership and how they've been impacted with the legislation changes over the years. Now, I appreciate it's very much on a case-by-case basis.
Very much is.
But fundamentally, when isn't it more tax efficient to buy an investment property through an SPV?
Okay, by SPV is a company.
Yes.
Right, so there's a lot of confusion over that. What's an SPV? What's a company? Yes. SPV and a company are the same thing.
Yes, special purpose vehicle for the purpose of our audience.
Indeed. Right, so when isn't it a better idea? Okay, so you've got some very specific circumstances in when it may not be a great idea. Okay, I would suggest that it is if you are a basic rate taxpayer, so your total income is under the 52,000, right? You don't intend to go above that substantially with your property purchases. You're only buying 1 or 2 properties, right? I'd say as a married couple, that you utilise both basic rate bands, right? In those circumstances, it's easier to hold them personally from a tax point of view.
Right. Because
you don't lose any tax through being in a high rate tax bracket. Your interest, even though it's calculated in the same way, you pay 20% tax. You are then get the 20% relief, so it's exactly the same. Okay, so what are the tax implications of transferring? And I use the word transferring loosely because I know you're going to tell me it's a sale. Between sort of personally owned properties and moving those into a limited company. A lot of people say to me, we're just transferring it, we're just remortgaging it. It's not a remortgage. It's not a remortgage. So let's look at it. What it covers, there's 2 taxes that covers, right? Everybody's aware of capital gains tax, okay? And in the very first line of that bit of legislation, just for a little bit of education, it says capital gains tax is a tax on disposals, right?
Okay.
So, yes, I refer to it as a sale because it's easier to refer to as a sale. If you dispose of an asset, so you are disposing of a property, because under English law, a company is a separate person, okay? If you dispose of an asset, you are selling it, disposing of it, and therefore it is subject to capital gains tax. unless there's a relief available. Right?
Right.
There's another specific rule that says if you'll dispose and give it to a company you own, right, you can't get round it by fixing the value. We will deem it to be valued at market value. Now, you can have your paperwork saying nothing, you can have your land registry saying nothing. The taxman will come along and go, that's a market value disposal. Okay? So on that transfer, disposal, sale if you like, you are subject to capital gains tax on the market value of that property, less whatever you paid for it, plus a few other costs.
And what about, because obviously it is deemed a purchase if you're transferring it, depending on how you're doing it, I'm guessing.
Correct.
So because if you're selling it to your SPV,
Yep.
Newly formed,
Yep.
we'll just say that, it's going to be subject potentially to stamp duty, land tax.
It will, in the vast majority of cases, be subject to stamp duty, land tax. So a lot of these things, a lot of the webinars, I'm kind of keen on educating people. Stamp duty, land tax is not chargeable on value. It's chargeable on the consideration given.
Right.
Right? With one exception. That exception being, will you transfer your property to a company you own? And in those cases, the company has to pay stamp duty, land tax, plus the additional 5%.
Right.
Right?
Okay.
On the first purchase, they'll get a one property exemption on the acquisition of that property.
Right. Okay. And I think that's what a lot of people don't understand. And it would be amiss of me not to mention the Ramsey ruling, which I know you are so familiar with.
I'm very familiar with this.
So obviously, I'm guessing a lot of the companies or individuals that had large portfolios have, a lot of them have incorporated already and taken advantage.
Less than you think.
Really? Okay, that's interesting.
Yeah. So I was telling before, capital gains transferred to a company is taxable unless a relief is available. And that relief is known as incorporation relief. Right. And it's a little bit big and messy, but I'll try and simplify it down.
Please do.
No worries.
Good luck.
Thank you very much. Right. Okay. So, incorporation relief. When you transfer your properties to your company, you haven't been given any cash. Okay. It's what's known as a dry disposal. So technically taxable, but no money to pay it with. Okay? And the revenue recognise that fact, right? And allow for the fact that when you transfer in a property business, okay, rather than what they consider to be passive investment assets, you can defer that gain into the share capital that you receive. So basic contract law requires you to transfer an asset in and get something in return. In this case, the something in return is shares in the company.
Right.
Okay. So let's say you transfer in 10 million of property and there's an £8 million gain sat in that property. Okay. The company gives you shares worth £10 million.
Yep.
But if you ever sell those shares, the maximum amount you can deduct for tax purposes on a sale will be 2.
Right. Okay.
Right? So the 8 million at that point, and I shouldn't say sell, I should say dispose. The 8 million at that point becomes taxable. So it's not, doesn't wipe out the gain, it defers it.
Okay.
Okay?
Again, another misconception.
Common misconception, that one. Right, now a property business is one beyond where you passively hold the assets. Okay? So let's say, for example, even if you had a really large portfolio, if you had a property manager managing it, okay, and you're not doing a great deal, right? You're not running a business. You're taking income from an asset. It's like holding shares and taking the dividends.
Yeah, absolutely. Yep. I get that.
Whereas if you are actively managing, doing the repairs, sorting out all sorts of stuff, involved in the leases, the Ramsey ruling went for 20 hours a week. The revenue guidance says they are happy with 20 hours a week. It doesn't necessarily need to be 20 hours a week. It just needs to be you're actively working on your business for a substantial amount. That would be considered sufficient to be a property business, and you would therefore be entitled to look at claiming incorporation relief.
And do you have to do that by doing an LLP kind of step?
No, that's another common misconception, right?
Yeah.
So the LLP thing is to do with stamp duty.
Right.
Completely separate tax issue, nothing to do with the capital gains or the incorporation. Individuals and LLPs can claim incorporation relief if they meet those requirements.
Right. Okay. Interesting. That's covered quite a few points that I know we get asked on a regular basis.
Good.
So thank you for that. Now, can landlords reduce their tax by splitting ownership with their spouse or partner where it's in their personal names? And can it be done retrospectively? And what are the rules around your favourite Form 17?
I love Form 17.
Which I know, and declarations of beneficial interest.
Okay, right. So when we say spouse or partner, it would have to be spouse or civil partner.
Okay.
Right. So there is a specific rule in tax legislation that allows you to transfer capital assets between spouses or civil partners without a tax charge.
Okay.
If you dispose of an asset to a, for want of a much better phrase, live-in partner, yeah, you've got a disposal and you would pay capital gains tax on that transfer. Okay. So yes. Now I'll come back to the earlier points of it's all to do with where those individuals sit in the income tax bands. Yep. So if you are a higher rate taxpayer and your spouse is a lower rate taxpayer, then yes, you can transfer an interest in your property to take advantage of the lower rate tax. You've got to transfer both the capital interest, by that I mean the value of the property, and the interest income. You can't just transfer a rental stream.
Right.
Yeah.
Okay.
So they do have to take an ownership share in the property. I get asked a lot of questions around that in divorce.
Oh, yeah.
To be honest, it's up for grabs anyway.
Yes.
Yeah.
Fair point.
It is. So it's kind of a little bit of an irrelevance, that one. Right. If you're in that situation, right, and it doesn't matter the split, okay? So even if you're 99-1, the revenue's default position is that if there is a spouse, civil partner holding joint interests of any description in a property, it is split 50-50.
Oh, that's interesting.
Yep.
Okay.
So you are taxed on 50% of the income, even if you're a 1%, right? Which sort of defeats the object.
Yeah.
Okay. Unless you can provide them with specific evidence that the split is different. Okay. Now, the specific evidence can actually be a legal conveyance showing different splits, so the tenants in common rather than joint owners, or it can be what's called a deed of trust, which is you keep legal title, but your spouse is beneficially entitled to all the risks, rewards, benefits of the property, both legal mechanisms, and a decent lawyer will be able to explain the difference. The deed of trust is often simpler rather than trying to get a partial conveyance done on a property.
Right. Okay.
Right?
Yeah.
Once you have that evidence, you need to then complete Form 17, supply that to the revenue with Form 17, and from the date of submission of Form 17, if the revenue are in agreement, you can then tax the properties in the revised split, but it can't be retrospective.
So another question for you then. So many lenders, and I include ourselves in this, we have options of different fee bandings, as in lender arrangement fees, in order to provide cheaper rates. They're very popular at the moment. One of the questions that comes up regularly is when landlords hold the properties in a limited company, can they offset that lender arrangement fee as part of their tax?
They can, and if you don't mind, I'll expand that a little bit.
Please do.
So let's start with sole trader position first.
Yes.
Right. So the interest restriction everybody talks about is actually a finance cost restriction, right? So your arrangement fee is caught by that as well.
Oh, okay.
Yeah. So you are restricted to a 20% deduction on the arrangement fee, just like you would be on the interest cost, which a lot of people don't know about. There were a few lenders for a while, I don't know if they're still doing it, but there were a few lenders for a while who were promoting higher arrangement fees to get people to fall out of the restricted interest cost, and it doesn't work. Right.
Okay.
In a limited company, yes, you can take a deduction for the arrangement fee. But it gets a little complex in that it has to be done in accordance with accounting policies. Right.
Okay.
Now, what happens under most accounting is that the arrangement fee is split over the life of the loan.
Right.
Right.
Okay.
So if you've got a 5-year loan, you can deduct the arrangement fee. The arrangement fee would likely be carried, getting quite technical, on your balance sheet and released to your profit and loss account over the 5-year period. But basically what that means is over the 5-year period, you would get relief for that arrangement fee.
In your experience, what should landlords and brokers be mindful of if the rental income's paid to the limited company, but the properties are held in personal names?
Don't do it. Sure. Honestly, it's an absolute...
Babe, let's end that
It's
there.
absolute disaster. I've seen this structure so many
Oh,
times.
I know, it came up recently and
Yeah.
we were asked about it, and that's why I was keen to get...
So you have, right, properties are held in a limited company. The rental income is paid to... Sorry, the properties are held in personal name,
Correct.
presumably to get the capital gains advantage on sale.
Or they've held it for some time.
Yep.
Mm-hmm.
The rent is paid to a limited company, right?
Yes.
Now, legally, how?
Maybe it's a letting agent. Maybe they've set up a letting agent.
Right, but then...
I'm going to use that.
So the individual technically would need to have granted leases
Right.
to the company. The siphoning off of rent to a company with no legal transfer is just... It can't be done. It is done, but it can't be done. You under land law, tax law, right? If rent is going to a company, what's it rent on? Well, so it's rent on the properties that guy owns. So why do you own them? You've de facto got a disposal of the properties on which potentially capital gains tax and stamp duty land tax is due.
Right.
Right? Secondly, in that circumstance, the mortgage will sit with the individual. Yep.
Yep.
So the limited company will not and should not get relief for any interest costs because it's not got the debt allocated to it. Yeah.
Yep.
It's an absolute disaster of a structure and should be avoided at all costs.
So looking at when landlords actually come to sell their properties, because that's something that we don't necessarily always get involved in, because it's obviously at the end of the process. But I think it's quite good for brokers to understand, what are the implications as far as their landlords are concerned.
Yep.
So when they actually when the landlord comes to sell their properties, what are the tax implications? I mean, we've talked quite a bit about capital gains, but and can they deduct any costs against that?
Certainly can. Capital gains tax. When you sell a property, it's a capital gains tax transaction, unless you're a property developer. And this is worth picking up on because I imagine you may fund property developers from time to time.
Well, you certainly deal with property developer exits. So,
there's a lot of people who will... Let's go on that first, because that's quite interesting. Let's say you are sole trader again, outside a company, right? And this is one of the huge misnomers out there. You are a property developer or you do a refurb. So you kind of like buy, renovate, sell on. And they think they pay capital gains tax. And you don't. You're trading. You're trading in properties, right? So you're buying with the intention to sell. And that under the tax rules is a trade. So you're subject to income tax on that. Yeah. Okay. So if you're going to be a property developer, that is generally always worth doing in a company because the profits can be pretty high and you find yourself with a 40-45% tax charge if it's outside of a company.
Yeah.
Okay?
And does it make a difference on the percentage of works that are carried out?
No, it's intention. Right? Okay. Purely intention. So if your intention when you buy an asset is to resell it, that's an adventure in the nature of a trade.
Okay, very helpful for our bridging finance. So we'll be very excited about that. And how and when do you report any or pay any capital gains tax on UK property sales?
So we're looking residential properties again?
Yeah.
Okay. So if you sell a UK residential property, you have to do a specific tax return within 60 days of the disposal and pay your capital gains tax in that. You also have to re-report it in your annual capital gains self-assessment return. You don't pay any additional tax, but it does need reporting in your annual self-assessment. And your stamp duty land tax, which is the purchase obligation usually, a form needs to be filed and paid within 14 days.
Right, okay. So we obviously are starting to see a number of really specialist structures as we're seeing landlords and their tax accountants becoming more sophisticated in what they're recommending. So what do investors purchasing through a trust need to be mindful of?
Trusts. Use trusts occasionally, okay? trusts aren't necessarily that complex. They're not particularly tax efficient. Okay? A trust it's a legal structure whereby somebody who wants to leave funds, property to a party, but doesn't want them to have direct access to it, puts it into a trust where trustees look after it, and the beneficiaries obtain the benefit if, as and when the trustees say so. The trustees have an obligation to act in the best interests of the beneficiaries, and the trustees are the legal owner of the property.
Right.
A trust can purchase a property if the trustees deem it to be a worthwhile investment, but they've got to assess whether it's a worthwhile investment. Trusts are fully entitled to same levels of interest relief. I think they have full interest relief in trusts. And all the other it's just like running a property business through a trust. However, trusts pay the top rates of tax regardless. So your income in a trust will be taxed at 45%. Yeah.
And that's the thing that people need to be aware of, isn't it?
Really is. Now, the way trusts work, if the income is passed out to the beneficiaries, the tax is recalculated based on the beneficiary's position.
Oh, okay.
Okay. And the beneficiary may be able to recover some of that tax paid by the trust.
Okay.
So it's worth looking at.
Interesting.
Yeah. So that's how they become efficient. But they're not particularly tax efficient structures, but they are very good for protection.
Yes.
Yep.
Yeah. I know we were discussing that
We were.
before we came on our session today. And if we look at SIPs and SASs,
Yes.
because that's another area as well, especially because we lend in the commercial space ourselves.
Yep.
So how are you seeing those? What sort of...
There's changes going on at the moment. So look, let's be really clear. Pensions cannot invest in residential property. And if you have land in pensions that you put up for development into residential property, you've got to get rid of it before you start building into residential property.
Right.
Okay. So it's one of two things pensions can't invest in: fixed asset, which is tangible, movable type, plant, machinery and that kind of thing, and residential property. Okay. In terms of commercial property, there used to be an excellent way of buying property, right? Trusts do pay stamp duty land tax. Sorry, not trusts, pensions, forgive me. Do pay stamp duty land tax. But after that, there's no tax. There's no capital gains. There's no tax on the income. Yeah. So a lot of trading businesses used to sell their commercial premises to directors' pension schemes.
Yeah.
And then what you'd get is, because it has to be a market rate of interest. So the interest was tax deductible in the company, not taxable in the pension. Yeah.
Yeah.
And if the pension ever sold the property, there's no capital gains tax. There's a couple of quirks with VAT, but that's quite a podcast episode in itself. So let's not go there. You may or may not need to register for VAT in the pension. Okay. Now, the problem now is that pensions are being brought into the charge to inheritance tax. And the reason a lot of properties were put in pensions was, one, the tax-free growth, but two, it was a great way of keeping it out of the inheritance tax, right? By having a property in a pension, as you'll know, they're not liquid. So there's not a great deal of planning you can do with it.
Yeah.
So if you find yourself with an inheritance tax charge on a large property, the only way to deal with it in a pension is to sell the property, and you're probably finding yourself in a fire sale. So people are reconsidering property and pension at the moment. Now, I wouldn't say no, because you've still got all that tax-free growth. So let's say early on in life, and actually you want tax deduction in your company and you want the tax-free growth and you think it's a good investment. So if you can get the capital growth on the property and a great rental stream into your pension, why wouldn't you if it sets you up in a pension? But there's a little more caution around them than there used to be.
Right. Okay. So just make sure you do your due diligence beforehand.
Very much. Think to the future. See
Yeah.
a tax advisor, maybe.
We'll give John's details after this session.
So, yeah,
And what about family investment companies? Because again, that's something that I'm certainly getting asked for a lot. It's coming up a lot in the webinars, etc., that I host with the clubs and networks. So, what's your view on
family investment companies?
companies?
There's a lot of smoke mirror and mysticism about family investment. Family investment company is a company, pure and simple. It's a company. Shareholders own companies, right? And there are 3 rights that attach to shares. One is a right to control through votes, one is a right to an income through dividends, and the other is a right to the capital value, the growth in the company, right? What a family investment company does is split those rights. So you, as, say, parents having a decent amount of property, decide that you are looking to put that into a family investment company, okay? You may have a capital gains tax charge, you may have a stamp duty land tax charge, right? And let's go back to the 10 million. It's worth 10 million. The family investment company then owes you 10 million pound.
Right.
Right. You freeze your value of the company at day one, right?
Mm-hmm.
And the value of the company at day one is basically nil, because you put 10 million of assets in and the company owes you 10 million of assets out in the form of the loan. So the value of the company is nil. Your third class of share, second or third class of share, depending, goes either to the children or to a trust for the children, and that has the future growth of the company. Okay? So, you've got the votes, you've got the control. If it's trust, you can be trustee and control that as well. Right? You've capped your inheritance tax exposure to the loan value. Okay?
Yep.
As you spend that loan, which is tax-free, once you've paid your initial capital gains tax, your inheritance tax goes down, right?
Okay.
And we all know property grows. And let's say we're looking 20, 30 years of a family investment company, it could have doubled or tripled in that time.
Yeah.
All that future growth falls outside of your estate in the shares that are in the trust, not in the trust itself. And the kids can't access that value because you control the company. Okay? Now, there is something called a 10-year charge on a trust, right? And it's a 6% charge every 10 years on the value of the assets in the trust. But if you're able to pay up a 1% dividend every year, it's like the cost of running a trust. Right? Okay. It allows you to therefore spread inheritance tax out the way, keep that growth outside of your estate, and provide for future generations. And it's multi-generational, because ultimately when you pass, your shares have very little value. Yeah?
Yeah.
You've probably got enough money for you to live on through the 10 million loan drawdowns. If you find it's too much, you can give that away. And then after 7 years, that falls outside your estate.
Yeah.
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 But at the end of the day, it is just a company. Yeah. So it's not, and I know a lot of people saying it's complex structure. It's not that complex in my world. I understand from a lending point of view, it might be.
Yes.
Yeah. But it's actually relatively straightforward.
Oh, I'm sure there are many brokers out there that are delighted to hear you say that. So
there are many accountants who aren't.
So I'm going to ask a controversial question now. So what are the pros and cons with regards to share purchase agreements? So we're seeing, obviously, since the changes in stamp duty, land tax in particular, especially with foreign nationals, etc., that a lot are actually looking to purchase existing limited companies that hold property rather than the individual properties themselves. Appreciate that they're not necessarily paying stamp duty, land tax. The title's not changing, but they are actually paying stamp duty on the electronic shares. So just talk us through your thoughts on it.
It's not that controversial. I think it becomes controversial when people don't realise what they're getting into.
Yeah.
Right. So company is a separate legal person. Under the purchase of a company, you're not purchasing the property, you're purchasing the company holding the property, and it comes with all its baggage. Right? So let's say that company acquired that property worth 10 million.
Yeah.
Sorry, worth $1 million, right? And you're many, many years later and has had development, that kind of thing, is now worth 10 million, right? And that would be a massive amount of stamp duty land tax, right? So you agree that you will purchase the company, right? 10 million and pay 0.5% stamp duty, okay? If the company sells the property in the future, the cost the company can deduct is still only £1 million. Right. So as purchaser of that company, you are picking up its historic cost. It is not £10 million, which is the amount you've spent on it. Okay? So if your intention is to sell it on, absolutely don't do it. Right? If your intention is to keep it as an investment, there may be some benefit to you in doing so.
Right.
If you sell on the company, your shares cost you 10 million, right? So you can deduct 10 million because that's what you paid for the shares.
Right.
Right? As the seller, okay, when they come to do their tax calculation, right, might be better for them. So in our example then, I imagine it very much would be better for them. They are selling the shares in the company, okay? If they sold the property, company will get 10 million in, could deduct $1 million, pays corporation tax on 9 million. And then they've got to liquidate the company to get the cash out, assuming they can, right? Assuming no other assets. And the best tax rate they will get there is 24% capital gains tax.
Right.
Right? If they sell the company, they sell the shares. Now it's likely they only paid £100 for the shares. Yeah? So they can only deduct the £100.
Right.
But they're only paying one lot of 24% tax rather than the double layer of corporation tax and capital gains tax. So it frequently works out better for the buyer to sell the shares.
Right.
Right?
Okay.
And the revenue don't particularly have an issue with any of this because there's no loss of tax to them.
No.
Yeah?
Okay.
There's no step up in the cost of the property. It works for them. So it's people say it's controversial because you're not paying the stamp duty and tax. No, you're not. The revenue is patient. Yes.
That's a great way of looking at it. And as I say, we've definitely, as a lender, seen an uptick in it, especially since some of the changes that came in October and April this year, which is probably no shock to you. And the great news is that we can do that on our residential buy-to-let products. So we're one of the few lenders that will actually allow that, which is great news, not just on bridging finance. So another little...
They're very difficult to find.
So they are, yes. I was going to make a comment then, and then I thought no, because it will have to be cut out of the webinar if I say that. So let's look to the future now. Let's get your Mystic Meg ball out. So we've got Rachel Reeves poised to launch a reviewed Blitz on Business Bureaucracy. I saw in a paper earlier this week in her November budget. I'm going to ask you about that in a second, what your thoughts are. But what trends are you starting to see across the property tax landscape at the moment?
A lot more inheritance tax planning.
Right.
An awful lot more inheritance tax planning. She's attacked reliefs known as business relief and agricultural property relief. And she's particularly attacked landlords. And I know anybody within those industries know the consequences of what she's doing. But they are small sectors of the population. So whilst internally it's making a loud noise, externally the voting public wouldn't have a lot of sympathy until they can't find anywhere to live. So I'm seeing a lot more inheritance tax planning at the moment, and a lot more people endeavouring. There is a lot more incorporation being talked about because they're finding the income tax rates too high.
Right.
Yes.
Okay.
So those are the main trends in the property things I'm saying.
Okie dokie. And I suppose, are there any sort of up-and-coming property tax changes landlords and investors should be aware of over the next 12 to 18 months that haven't come in yet?
Not that I'm aware. Nothing that's been announced as yet. But we have, yes. In about a month's time, we may have a few.
And what would be your kind of top tip, if you will, for brokers to be telling their landlords as we're moving into 2026?
Get tax advice.
From Alexandra and Co.
Then, is there anyone else? No. A lot of what I do turns on details, and a little bit of knowledge is dangerous. Yeah. And I mean, we've both said today we've come across scenarios whereby people have got it wrong, and it's regular. Yeah. And it's messy and it's painful. So flippantly say get tax advice. Take some form of advice when you're doing transaction, do it beforehand. The other top tip is and as I say this a lot, it's because it can save stamp duty. If you have a couple of people who are starting with a couple of properties and don't know which to start in a partnership.
Right.
Right?
Okay.
Rather than joint ownership, starting a partnership, because it gives you a potential option later, even if you don't use it, to save stamp duty land tax on the later incorporation.
Right. Okay. That's a fantastic tip.
Yeah.
And lastly, but by no means least, any predictions?
Predictions,
for the,
right.
November budget?
Yeah. And it comes back to what I was saying earlier. She has said that she will not put up workers' taxes, right?
Yeah.
Whatever she calls them. Won't touch VAT, won't touch income tax. I forget the national insurance for employees, though she has. And it is clear that she is looking to raise taxes somewhere. And there's a lot of sign of those with the broadest shoulders now. Who knows who those with the broadest shoulders are? You would think that actually by putting a penny on income tax, those with the broadest shoulders would pay proportionally more as they do at the moment. So it seems that she's going after asset-rich people, right? Which property owners do fall into. A wealth tax, which has been mooted, right, is phenomenally difficult to administer, right?
Right.
And the reason is a wealth tax is you have to be able to calculate an individual's wealth, which means you have to be able to calculate the value of their assets on an annual basis. And that's damn near impossible.
Right. Okay.
Yeah. So if you went to a landlord and it's kind of like, right, what are your properties all worth? And what's the level of debt against them? That kind of thing. Okay.
Yeah.
So she may look to do some sort of tax on certain value property transactions.
Right. Okay.
And she may also look, the other one being mooted is national insurance on rental profits.
Yeah, I heard that one.
Which then actually brings you all around to incorporations again. I don't really know what she's going to do, but she has limited her options and potentially against what she should do.
Yeah. Unless, of course, she backtracks.
Which I don't think anybody would actually have a problem with.
No.
Yeah.
No, if it comes to the right decision, I think
Indeed.
that's probably the right thing to do.
Yes.
Well, we will eagerly await to see how that plays out as we move towards the end of November. But listen, thank you ever so much, John, for coming
my
down
pleasure.
today. I know you've travelled a long way to join us.
It was a very pleasant journey.
Here in our offices in Victoria. So thank you ever so much. Wealth of knowledge. And we really appreciate it. So
My pleasure. Thank you.
If you enjoyed this episode, don't forget to subscribe, rate and share it. You can access our previous episodes in all of the usual places, as well as on our website at www.mfsuk.com/podcast. You can also stay connected with us on Instagram at mfs_LTP. See you next time.